In this lesson, we're going to look at the market structures which help us understand the context of the market better. Structures are simply a visual attempt to represent how the market is moving. We mark highs and lows to see who's in control, where liquidity lies, and which market phase we are currently in. This allows us to position ourselves on the right side and statistically gain an edge. The first visual I have for you is the bullish structure. A bullish structure forms when the market moves from a low to a higher low, and then makes a higher high. We need 4 points to identify a trend structure here. The higher high is the most important confirmation point. This tells us the market is an uptrend, and we can look for long opportunities at the next higher low, aligning with the market sentiment. As long as the previous higher low is not broken, the bullish structure remains intact. The important part here is we identify a higher high, we wait for a retracement, making a higher low. In this retracement, we can place our trade in, for example, in a fair value gap, which we talk about later as well. Now we come to the second visual, the bearish structure. The same concept applies to the bearish structure. The market moves from a high to a low, then a lower high, and then a lower low. The lower low is the key confirmation level here again. As long as the previous lower high is not broken, the bearish trend is still valid. Again, we need all the 4 points to define the structure. We need a high, a low, lower high, lower low. As soon as we identify the lower low, we can enter with a short trade when the market is making a lower high. Now we talk about the next structure. The break of structure, a trend break. A structure breaks when the previous high or low gets taken out. This is what we call a break of structure, also BOS. This signal is a potential shift in the market flow or sentiment. For example, from bearish to bullish or vice versa. To confirm a full shift, you still need the 4 key points to define either a new bullish or bearish structure. In this example here, we had a downtrend. High, low, lower high, lower low, downtrend. We made a lower high, we made another lower low. But after the latest low, we made a higher high. So we have a break of structure from the lower high to the higher high. Now we wait for the market to make a new higher low. If it does, we could already enter the trade here, but this one would be more risky. A more safer example would be we wait for the market to make another higher high, confirming the long structure and entering in a long trade after. Now we come to the last visual, the range. Another phrase to recognize is the range. In a range, there's no trend. It's mostly a consolidation zone where liquidity builds up. You must always connect this with the first building block, understanding the market phase. Ranges are typically found during an accumulation or distribution phase. Usually, one side of the range gets liquidated, followed by a strong push in the opposite direction. We got deeper into this in the later video, but here again. Here we see the range. The red lines mark the range. We see a liquidity grab to the top. With this liquidity grab, we are kicking all the short sellers out who placed their stop loss over the previous high. As a result, we make a new low. We also kick out the long buyers here, and then the institution, for example, on the bottom low can establish multiple long positions, and then we see an exit out of the range with a long trend. We will take a closer look in a later video in all of this. See you later.